Welcome to Facts Not Forecast, your daily edge in the stock market facts, insights, and opportunities you won't hear anywhere else. Today, we're taking a deep dive into a company that's constantly in the headlines, inspiring both fervent belief and, let's be honest, some serious skepticism. Tesla. Just recently, Elon Musk claimed that Tesla's Optimus robot could one day be worth more than its entire car business. That's a bold statement, and frankly, a valuation many struggle to wrap their heads around. But, is it realistic for investors?
Yeah, let's try and cut through the noise, right?
Yeah.
So focus purely on the facts you've asked us to unpack. Our mission today really is to explore Tesla's core financial health, dig into its diverse business units, the ones beyond electric vehicles, and critically examine what all of this means for its long-term investor implications.
Okay.
We have a wealth of recent data here. Market performance, analyst sentiment, the expansion of these ambitious projects.
Okay, let's unpack this. When most people hear Tesla, their minds immediately go to sleek electric cars, obviously. But the data reveals a company deliberately, maybe even aggressively, diversifying its portfolio. It's almost as if it's preparing for a future where cars are just one piece of a much larger puzzle. So, beyond the automotive core, what exactly does Tesla mean by its energy generation and storage segment? And why is this suddenly, so important?
That's a really crucial point, and it's definitely more than just a sideline. Beyond the automotive segment, which, yes, covers designing, making, selling, leasing EVs, Tesla operates this significant energy generation and storage segment. And this isn't just selling a few Powerwalls for homes. We're talking design, manufacture, installation, sale, lease of solar generation, and these massive energy storage products. Think utility-scale megapacks.
Right.
What's kind of fascinating here is that while this segment has always been around, some recent reports actually described it as declining before this new concerted push.
Interesting.
Yeah, it indicates that converting their tech prowess into consistently profitable, scalable non-automotive revenue, well, it hasn't exactly been a smooth road.
And we've seen headlines recently about specific products here, haven't we? It's not just theoretical diversification. They seem to be making pretty big moves. What do these new product launches tell us?
Absolutely. You're likely thinking of the recent reports highlighting Tesla unveiling its Megapack 3 and the new Megablock battery storage systems. The company is actively doubling down on energy storage, which to me reveals a kind of strategic necessity. It feels less about simply expanding into new markets and maybe more about shoring up a critical leg of their diversification strategy.
Yeah.
Aiming to reverse that earlier decline you mentioned. The goal seems to be establishing a really robust utility-scale energy storage business that can genuinely contribute significantly to their bottom line, separate from just vehicle sales.
So it's not just about the physical energy hardware then. There's this strong AI and software component weaving through everything as well, right? Which seems to be a huge part of their overall strategy, trying to push Tesla beyond being seen as just a pure manufacturing play. How does that fit into the bigger picture?
Precisely. And this is where Tesla really tries to transform the narrative, I think. Analyst views increasingly frame Tesla's expansion into autonomous services and full self-driving, or FSD, subscriptions as a clear shift. They're moving toward a high-margin, recurring software revenue model.
Right, the holy grail for valuation.
Exactly. And look, this might not just be a choice. It could be a strategic necessity to offset the commoditization risk that's rapidly emerging in the EV market itself. Tesla isn't just choosing to be a software company. Arguably, the core automotive business might require it to survive at its current valuation. What's more, you look at Tesla's AI advancements driven by specialized hardware, like its Dojo supercomputer and the Cortex-1 training cluster. I mean, these are custom-built supercomputers designed for massive AI model training. It genuinely positions the company as a major AI player. Some analysts are even calling it an AI stock that matters more than cars.
That active push and the shift to high-margin software is compelling, no doubt. But from an investor standpoint, how much of that is, let's say, speculative hope versus concrete near-term revenue generation from AI products like FSD? What are maybe the biggest technical or ethical hurdles to really monetizing that AI fully?
Yeah, that's the core tension, isn't it? While FSD subscriptions offer that recurring revenue dream, the path to widespread adoption is, well, it's fraught with technical and regulatory hurdles. The software still requires a safety driver in many real-world applications today.
Still needs supervision.
Right. And public trust, alongside evolving regulations, that's really going to dictate the pace of true monetization.
Yeah.
So while the potential is massive, the current reality involves significant R&D investment in navigating a really complex environment before that high-margin revenue becomes truly dominant.
Okay, here's where it gets really interesting, and it connects directly to that AI ambition. Tesla's robotaxi vision. This is such a huge part of the beyond cars narrative.
Mhm.
How far away are we, realistically, from widespread driverless robotaxi services from Tesla? And what specific steps are they taking right now to bridge that gap from just a vision to, reality?
The robotaxi rollout is definitely seen as central to Tesla's long-term story and, frankly, its future valuation. It's largely powered by their FSD software ambition.
Right.
And we are actually seeing real, tangible steps being taken now, moving beyond just simulations.
Like what?
Well, for example, Tesla is seeking permits right now to offer ride-hail services at Silicon Valley airports. That's a big step. They've also launched a ride-hailing service in the San Francisco Bay Area. Now, currently employs its self-driving tech, but for now, a safety driver is still present.
Okay.
But these are crucial public testing grounds.
So they're moving beyond simulations into real-world applications. That is significant. But is it all smooth sailing? Or what are the immediate lessons or maybe hurdles they're encountering as they transition from controlled environments to public roads?
Oh, there are definitely snags. Yeah. Recent reports indicate that Tesla Robotaxi app hit snags in first public rollout. That really highlights the immense potential regulatory hurdles they face.
Right, government's getting involved.
Exactly. Deploying such a complex, safety-critical service on public roads demands rigorous testing and government approval. That's not happening overnight. And the sheer complexity of safely deploying, scaling, maintaining such a service, especially in diverse urban environments, it's immense.
And they're not alone either.
No, absolutely not. We can't ignore the heating competition. Other players, like Amazon's Zoox, have already launched their robotaxi service in Las Vegas. It shows the self-driving race is intense, and Tesla isn't the only one with this ambition.
These real-world snags in autonomous driving give us a crucial reality check, I think. So when Elon Musk then makes an even bolder claim that his humanoid robot, Optimus, could be worth more than the entire car business, we have to ask, how do analysts even begin to model such a future? What timelines are they projecting?
Yeah, that's the multi-trillion-dollar question, isn't it? The analysts' narratives that tie Tesla's future valuation to humanoid robotics, well, they're based on the premise that these breakthroughs will unlock entirely new, recurring, high-margin revenue streams on an unprecedented scale.
Like robots doing jobs.
Essentially, yeah. We're talking about industry-disrupting margin expansion, where robots could potentially perform tasks currently done by humans across countless industries. Some estimates, in fact, Project Tesla could be worth as much as $8.5 trillion if Musk hits his very ambitious pay targets. And that number implies a colossal contribution from these non-automotive segments, including Optimus, alongside the robotaxis.
So it's not just a far-off dream for some investors and analysts. It's actually baked into some of their valuation models, even if the timelines are still, let's say, a moving target. What specific plans, if any, have been laid out for Optimus and maybe other robotic vehicles beyond just the humanoid form factor?
Correct. The perception is definitely that these projects can be transformative future revenue drivers. Though, yeah, the timelines are still a subject of much discussion and depend heavily on execution. Elon Musk himself has previously announced that production of the Cybercab, that's their proposed fully autonomous taxi service vehicle, would begin before 2027.
Okay, so a target date there.
A target date, yes,
Mm-hmm.
and with a target price under $30,000. This is alongside the introduction of a RoboFin, which sounds like an autonomous vehicle likely designed for delivery or perhaps shared passenger transport. These specific timelines and product definitions, they do suggest a defined roadmap, however ambitious it might seem, for these advanced robotic vehicles to eventually enter the market.
Okay, so while the vision for robots and robotaxis is captivating, its feasibility really fundamentally rests on the performance of Tesla's engine room, its core automotive business. And the landscape there seems to be becoming increasingly brutal. What are we seeing in terms of competitive pressures and Tesla's market share in the EV world right now?
Yeah, the data clearly shows increased competitive pressures. No doubt about it. Tesla is losing U.S. market share. And its market share in U.S. drops to lowest since 2017 as competition heats up.
Since 2017, wow.
Right. And what's particularly telling, I think, is that this is happening in the middle of an EV boom. So the overall market is growing rapidly, but Tesla's slice of that growing pie is actually shrinking. relative to others.
Hmm.
That suggests a significant challenge in maintaining its dominance, even as the tide rises for electric vehicles overall.
And who are the key players in this increasingly crowded, competitive landscape? Who is really eating into Tesla's market position?
Well, we're seeing significant challenges on multiple fronts, really. From Asia, you've got companies like BYD planning a fresh, aggressive push into markets like India, offering compelling, often lower-cost alternatives.
Youth affordability factor.
Exactly. And then from the traditional luxury segment, automakers like BMW and Mercedes, they're launching new, highly competitive luxury SUVs and EVs. They're directly challenging Tesla's market position, especially in the higher-end segments where it once, pretty much reigned supreme.
So it's like a pincer movement, pressure from below and above.
That's a good way to put it. Yeah, from both ends of the market.
Okay, given these stark market dynamics, especially the declining market share, what does this actually mean for Tesla's current financial performance? Let's get into some of those key numbers and try to understand their implications.
Okay, looking at the financials. Tesla's stock is currently trading around, what, $353.89. Market capitalization is approximately $1.12 trillion. Huge numbers. However, if we peel back the layers a bit, the PE ratio, that key measure of how much investors are willing to pay for each dollar of earnings, it's quite high, around 4.94.
Very high.
Extremely high. To put that in perspective, the average for even a mature growth stock is often, in the 30s or 40s. This soaring valuation is particularly striking when you look at sales growth for fiscal year 2024. It was only 0.95%.
Under 1%.
Yeah. Alongside a sales decrease of nearly 3% on a trailing 12-month basis and a quarter-over-quarter decrease of almost 12%.
Yeah.
And net income also saw a significant decrease over 52% in fiscal year 2024.
Wow, that certainly suggests some serious margin pressure on the automotive side, especially with those sales decreases. How do their profitability metrics compare?
Indeed. The margins tell a story, too. While the gross margin for 2024 was 17.86%, operating margin was down at 7.94%, and net margin was 7.30%. Now, when you compare this to, say, the S&P 500's average gross margin of around 31.6%, you can clearly see the squeeze on profitability in their core business.
Big difference.
Huge difference. It tells us that aggressive price cuts and that increased competition we talked about are having a direct impact on their ability to turn revenue into profit. Now, on a more positive note regarding financial health, Tesla does maintain a healthy balance sheet. Short-term assets exceed both short and long-term liabilities, and its debt-to-equity ratio has reduced significantly to about 8.9% over the past 5 years. So that's a strength.
Okay, some financial stability there.
Yes. However, the analyst consensus, despite all the future ambition, remains a hold, with an average target price around $318.15. That suggests some caution, maybe skepticism from the professional community about its immediate upside potential from here.
It's almost as if the market is holding two different companies in mind when it prices Tesla, isn't it? You've got the maybe struggling automaker with clear margin pressure, and then you've got this future tech giant with ambitious AI and robotics plays. That's a unique tightrope walk. So what does this all mean for you, the investor, looking at Tesla's long-term value? If the car business faces this margin pressure, how do these other units, energy, AI, robotics, how do they truly scale and actually impact the overall valuation?
This raises the most important question, I think. The long-term investor outlook hinges entirely on whether Tesla can successfully transition its narrative and its revenue streams from primarily an automaker to a truly diversified technology giant. Analyst views suggest that growth in energy storage, expanding gigafactory capacity beyond just cars, and AI-driven cost reductions are absolutely critical for improving margins and expanding the market.
Right.
Without these, that automotive pressure could become significantly more impactful and, frankly, harder to overcome.
It sounds like that AI stock angle we discussed earlier is really the linchpin for their future then. What mechanisms will allow these new ventures to truly unlock significant new recurring revenue streams that can offset the challenges in their core business?
It is absolutely the linchpin.
Yeah.
Autonomous mobility, humanoid robotics like Optimus, broader AI breakthroughs, these are seen by some, perhaps many, as the key to unlocking entirely new addressable markets.
Markets beyond transport.
Exactly. Think of robots as a service or AI software driving entirely new industries. This isn't just about selling a product one time. It's about creating an ecosystem that generates recurring, high-margin revenue through subscriptions, licensing services, you name it. This could create significant margin expansion and open entirely new addressable markets for Tesla, fundamentally moving beyond the traditionally lower-margin automotive manufacturing business. The belief, or maybe the hope baked into the valuation, is that if these other units scale effectively, they could not only offset any margin pressure on the car side, but actually drive the company to the kind of valuations that Musk himself envisions,
Like that $8.5 trillion
like
goal.
that ambitious $8.5 trillion goal tied to his compensation package, yeah. It's definitely a bet on the future, but one built on the potential for exponential returns from these potentially disruptive technologies.
We certainly covered a lot today, from the nitty-gritty financials and the tough competitive landscape of the core automotive business,
Hmm.
all the way to the ambitious, almost sci-fi visions for robotics and AI. It's clear that Tesla is at a really pivotal point, balancing its current challenges with its transformative future aspirations.
Yeah, this definitely gives you a lot to consider as you evaluate Tesla's future and where its true sustainable value might lie. It's a company of really stark contrasts, isn't it? Present challenges in a competitive auto market juxtaposed against this future, potentially defined by AI and robotics.
So, what stands out to you from this deep dive? Do you think Tesla's future is fundamentally in cars, or is it really in this ambitious, high margin world of AI, energy, and robotics? Let us know what you think. And if you want to stay ahead of the curve, make sure you subscribe to Facts Not Forecast. You won't want to miss our full Tesla Q3 2025 earnings breakdown coming up on October 15th, where we'll see if these projections are starting to bear fruit. Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.